All facts, figures, and conclusions in this video are drawn from publicly available information. Every claim can be verified, and full sources are listed in the description to maintain transparency. Roughly 3 weeks ago, something occurred that should have forced every major financial news network to halt regular programming. Instead, it slipped by almost unnoticed, quietly buried inside a routine SEC filing released late on a Friday afternoon, precisely when public attention is at its lowest. In that filing, Goldman Sachs, one of the most powerful and well-connected investment banks in modern history, disclosed something extraordinary. Over the span of just a few months, they dramatically reduced their holdings of United States Treasury bonds by hundreds of billions of dollars. This was not a minor adjustment. This was not routine rebalancing. This was a deliberate, systematic withdrawal from what is widely considered the safest asset class in the world. United States Treasury bonds are the foundation of the global financial system. They are treated as risk-free by textbooks, financial advisors, pension funds, and central banks. They are the collateral beneath trillions of dollars of global transactions. Yet Goldman Sachs looked at this so-called risk-free asset and effectively said no. They sold aggressively. And this is the part that should concern everyone. They are not alone. Over the past 18 months, major financial institutions have collectively sold more than $847 billion worth of U.S. government bonds. This number is not speculative. It is not an estimate. It is documented, verified, and filed with the Securities and Exchange Commission. $847 billion. To put that in context, that is more than the entire annual economic output of Switzerland. It is nearly 3 times the U.S. military's yearly budget. It is enough capital to buy Apple, Microsoft, and Amazon combined. The smartest financial institutions on Earth have made a unified decision. As of January 2026, they do not want to hold U.S. government debt. At the same time, the public narrative says everything is fine. Inflation is supposedly under control, the economy is stable, a soft landing has been achieved, and that raises a very uncomfortable question that almost no one in mainstream financial media is asking. What do these institutions see that you don't? What do the people with access to proprietary data, private intelligence, and decades of crisis experience know that would make them abandon the safest asset on the planet? That's what we're going to break down. I'm going to walk you through the exact data they're watching, the patterns they're recognizing, and the risks they're positioning against. And by the end of this, you'll understand why $847 billion in bond sales is not just a number, it's a warning. And it's flashing bright red. Before we go any further, we need to make sure we understand what a treasury bond actually is and why large-scale selling is such a serious alarm. When you buy a United States Treasury bond, you are lending money to the federal government. In return, the government promises to pay you back with interest. These bonds come with different maturities: 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, and even 30 years. Generally speaking, the longer your money is locked up, the higher the interest rate you receive. That part is simple. But here's the critical piece most people don't fully understand. Bond prices and interest rates move in opposite directions. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This is not opinion. This is mathematical reality. Let's make it concrete. Imagine you bought a 10-year Treasury bond in 2020 when interest rates were near zero. That bond pays you 2% annually, and you paid $1,000 for it. Fast forward to 2022 and 2023, when the Federal Reserve aggressively raised interest rates. New 10-year bonds are now paying 4.5%. Ask yourself this: why would anyone pay you $1,000 for a bond paying 2% when they can buy a brand new bond paying 4.5% for the same price? They wouldn't. To sell your bond, you would have to accept a steep discount. Maybe $750, maybe $700. That loss becomes real the moment you sell. If you're an individual investor, that's painful. If you're a bank holding hundreds of billions or trillions of dollars in bonds, it's catastrophic. Rising interest rates instantly create massive unrealized losses across your balance sheet. And this is not a hypothetical scenario. This is exactly what destroyed Silicon Valley Bank in March 2023. Silicon Valley Bank loaded up on long-term treasury bonds when interest rates were low. When rates spiked, the value of those bonds collapsed. When depositors got nervous and demanded their money, the bank was forced to sell bonds at huge losses to raise cash. Those losses wiped out their capital. The bank failed in less than 48 hours. That collapse triggered a chain reaction. Signature Bank failed. First Republic failed. The Federal Reserve had to step in with emergency programs to prevent a full-scale banking crisis. And all of that came from one mid-sized bank holding too many bonds during a rate shock. Now ask yourself a much bigger question. What happens when the largest banks in the world, institutions holding trillions in government debt, start selling not because they are forced to, but because they see something worse coming? That is where we are right now. Now let us get specific about what Goldman Sachs actually did and why this matters far more than most people realize. In their third quarter 2025 SEC filing, Goldman Sachs disclosed that their holdings of United States government securities dropped by 42% compared to the previous year. 42%. That is not a trim. That is not risk management at the margins. That is a liquidation. We were talking about a reduction from roughly $280 billion in Treasury and agency securities down to approximately $160 billion. That's about $120 billion in bonds sold in just a few months. And that's only Goldman Sachs. JP Chase reduced its available-for-sale securities portfolio, which includes treasuries, by 15% in the third quarter of 2024 alone. Bank of America sold $37 billion in securities in the second half of 2024. Citigroup cut its bond exposure by $23 billion. Wells Fargo, Morgan Stanley, and others followed the same path. When you add up the largest banks, you are looking at more than $300 billion in treasury sales over the past year and a half. And it doesn't stop there. Regional banks sold another $290 billion worth of government bonds. Combined, the total exceeds $800 billion. This is not isolated behavior. This is coordinated systemic movement across the financial sector. Officially, the banks will tell you this is about regulation. They'll point to Basel III capital requirements. They'll say they're optimizing balance sheets. They'll argue they need to maintain liquidity ratios. On the surface, those explanations sound reasonable. But here's what they don't want to emphasize. These banks are selling bonds at a loss. They are voluntarily locking in losses today that they could avoid simply by holding those bonds to maturity. Banks don't do that unless they believe holding those assets is even more dangerous than realizing losses now. They are choosing certainty over hope. That alone should make you pay attention. Now let's zoom out and look at the broader pattern, because Goldman Sachs isn't just selling bonds. They are repositioning their entire institutional strategy into a defensive posture. During their fourth quarter 2025 earnings call, Goldman's executives repeatedly emphasized liquidity and flexibility. Those words may sound harmless, but in banking language, they are red flags. When a major investment bank prioritizes liquidity during what is supposedly a stable economic environment, it means they're preparing for instability, and their actions confirm it. Over the past 18 months, Goldman Sachs increased cash reserves by 38%. They reduced exposure to commercial real estate by 29%. They pulled back from leveraged lending. They tightened credit standards for corporate borrowers. Every single move points in the same direction. Defense. This is not how banks behave when they believe the economy is strong. In healthy conditions, banks expand credit. They increase leverage. They chase yield. They load up on bonds because the income is predictable and the risk is considered minimal. Goldman Sachs is doing the opposite. They are hoarding cash, cutting exposure, and selling assets that are supposed to be the safest in the financial system. And this matters because Goldman Sachs is not reckless. They are not emotional. They are not reactionary. This is an institution that survived the dot-com crash, the 2008 mortgage crisis, the European debt crisis, and COVID. They didn't survive by being lucky. They survived by identifying stress early and positioning before everyone else realized what was happening. When an institution like Goldman Sachs exits government bonds on this scale, it's not speculation. It's analysis. They are running models you will never see. They are stress testing scenarios you will never hear discussed on mainstream television. And those models are clearly telling them that U.S. Treasury bonds, the backbone of global finance, are no longer a safe place to park capital. To understand why, we need to talk about the trap the United States government is now stuck in. As of January 2026, the Federal Reserve S benchmark interest rate sits between roughly 4.25% and 4.5%. That's down slightly from the peak in mid-2023, but still dramatically higher than the near-zero rates that defined the previous decade. At the same time, total U.S. government debt stands at approximately $36.2 trillion. And that debt is not free. Every percentage point increase in interest rates adds hundreds of billions of dollars in annual interest expense. In fiscal year 2023, the government paid $659 billion just in interest. In 2024, that number jumped to $879 billion. That's a 33% increase in a single year. Now, in 2026, projections show interest payments exceeding $1 trillion annually. $1 trillion spent on nothing but servicing old debt, not infrastructure, not healthcare, not defense, just interest. And the government does not have $1 trillion in excess revenue. So how do they pay it? They borrow more. They issue more bonds, increasing total debt, which increases future interest payments, which requires even more borrowing. This is a debt spiral. And the exits are limited. Spending cuts are politically impossible. Tax increases are economically damaging. Explosive economic growth is not happening. That leaves money printing or default. Neither option ends well. This is the structural reality Goldman Sachs sees. This is why they are reducing exposure now instead of waiting. Because once confidence cracks, the exit disappears. To understand where this is heading, we need to look backward. Financial crises don't repeat in identical ways, but they almost always rhyme. And history has already shown us what happens when a government reaches the limits of debt, interest rates, and credibility. Let's start with the last time the United States faced a true inflation emergency. In the late 1970s, inflation spiraled out of control. Prices were rising at double-digit rates. Confidence in the dollar was collapsing. To stop it, the Federal Reserve under Chairman Paul Volcker took an extreme step. He raised interest rates above 20%. That decision crushed inflation, but it came at a brutal cost. The economy plunged into recession. Unemployment surged. Housing collapsed. Entire industries were wiped out. But there was one critical difference between then and now. The United States government's debt burden was relatively small. Total federal debt was around 30% of GDP. The government could survive high interest rates because it wasn't drowning in debt. Fast forward to today, and the situation is fundamentally different. U.S. debt now exceeds 120% of GDP. Raising rates anywhere near Volcker-era levels would instantly bankrupt the government. Every rate hike now directly threatens the federal budget itself. The Federal Reserve is no longer just fighting inflation. It is protecting the solvency of the government. This creates a trap. If the Fed keeps rates high, interest payments explode, deficits widen, and debt issuance accelerates. If the Fed cuts rates too quickly, inflation reignites, the dollar weakens, and bond investors demand higher yields to compensate for the risk. Either way, confidence erodes. This is exactly the kind of trap Japan fell into decades ago. In the early 1990s, Japan was the world's second largest economy. Its stock market and real estate values collapsed after a massive bubble. To stabilize the system, the Bank of Japan cut interest rates to near zero. Government debt exploded as stimulus after stimulus was rolled out to support growth. At first, nothing dramatic happened. Japan avoided a sudden collapse, but what followed was something arguably worse. 3 decades of stagnation. Growth flatlined, wages barely moved, debt quietly piled higher and higher. Today, Japan's debt-to-GDP ratio exceeds 260%. The only reason the system hasn't imploded is because the central bank itself owns a massive share of the government bond market. Japan didn't crash. It froze. The United States is now approaching a similar crossroads, but with one crucial difference. The dollar is the global reserve currency. U.S. Treasury bonds are held not just by domestic institutions, but by foreign governments, sovereign wealth funds, pension systems, and central banks across the world. When confidence weakens in U.S. debt, the impact is global, and confidence is the key word here. Government debt only works as long as investors believe 3 things. First, that inflation will remain under control. Second, that the government will honor its obligations. And third, that the currency those bonds are denominated in will hold its value. Once any one of those pillars cracks, the entire structure becomes unstable. This is why bond market crises don't start with panic. They start with subtle shifts. Slightly weaker demand at auctions, slightly higher yields, fewer long-term buyers, more short-term speculation. These changes don't make headlines at first, but they compound. We've already seen early signs. In multiple recent Treasury auctions, foreign demand has been noticeably weaker. Primary dealers have been forced to absorb a larger share of issuance. The Federal Reserve has quietly adjusted liquidity facilities to keep markets functioning smoothly. None of this is accidental. This is how confidence erodes in stages. Stage 1 is denial. Officials insist the system is stable. Media repeats reassuring talking points. Markets remain calm. Stage 2 is adjustment. Large institutions quietly reposition. They shorten duration. They reduce exposure. They raise cash. This is the stage we are in right now. Stage 3 is stress. Volatility increases. Yields spike unexpectedly. Emergency interventions become more frequent. Officials still deny a crisis, but their actions betray concern. Stage 4 is loss of control. At this point, policymakers are reacting, not managing. Choices narrow. Printing money becomes the default response. Inflation resurges. The currency weakens. Bond prices collapse. And stage 5 is the aftermath. This doesn't always look like total collapse. Sometimes it looks like years of stagnation, declining purchasing power, and a slow erosion of living standards. But the damage is already done. The most dangerous part of this entire process is that it unfolds quietly. By the time the public realizes something is wrong, the exits are already crowded. That's why the smartest institutions move early. Not because they know the exact timing, but because they understand the trajectory. Goldman Sachs doesn't need a crisis to sell bonds. They only need to recognize that the margin for error is gone. When the bond market finally breaks, the damage won't stay confined to banks, hedge funds, or government balance sheets. It will hit everyday life directly, fast, and without warning. This is where theory becomes reality. Start with housing. Mortgage rates are directly linked to Treasury yields. When Treasury yields rise, mortgage rates rise with them. Today, the average 30-year fixed mortgage rate is already hovering near 6.8%, a level that has priced millions of buyers out of the market. But in a bond market shock, yields don't move slowly. They jump. If Treasury yields spike sharply, mortgage rates can surge to 9%, 10%, even 12%. Next comes retirement savings. If you have a 401k, IRA, or pension, chances are a large portion is allocated to bonds. Bonds are marketed as the safe side of the portfolio, the stabilizer during volatility. But when bond prices fall, those funds lose value just like stocks. In 2022, when rates rose from near zero to around 5%, the broad bond market suffered its worst year in decades, dropping more than 13%. That was with relatively modest rate increases. In a real Treasury crisis, where yields spike violently, long-duration bond funds could lose 30%, 40%, even 50%. The money people thought was protected disappears quietly, without headlines. Then there's employment. High interest rates act like a chokehold on the real economy. Businesses that depend on borrowing are the first to fall. Commercial real estate, already under extreme stress due to remote work and collapsing office demand, would implode. Construction projects would be canceled. Manufacturing would slow as equipment financing dries up. Retailers operating on thin margins and revolving credit lines would shut their doors. Layoffs wouldn't trickle in, they'd arrive in waves. In the 2008 crisis, unemployment doubled in less than 2 years, and that crisis began in housing. A Treasury market breakdown would be broader, faster, and harder to contain. Inflation is the other path, and it's just as destructive. If the government chooses to print money instead of allowing defaults, the purchasing power of the dollar erodes rapidly. This isn't mild inflation. This is the kind that changes behavior overnight. Paychecks stay the same while food prices double, rent jumps, energy costs surge. You become poorer without losing your job, simply because the currency buys less every month. History is full of examples. The United States in the 1970s, Argentina repeatedly, Turkey in recent years, Venezuela in extreme form. Whenever governments monetize debt, citizens pay the price. And perhaps the most dangerous effect is the loss of flexibility. Right now, you can still move money, rebalance assets, and make decisions calmly. In a full-blown crisis, those options vanish. Banks restrict withdrawals, transfers are delayed or blocked. Governments impose capital controls. Markets disconnect from fundamentals because liquidity disappears. By the time the danger is obvious to everyone, action is no longer possible. The exits are already closed. This is why Goldman Sachs is acting now, not later, while headlines still claim everything is under control. So what actually changed to trigger this shift? Why now? Several forces converged at once. The Federal Reserve began shrinking its balance sheet after years of aggressive bond buying. Nearly $2 trillion in treasuries were pushed back onto the private market. At the same time, government deficits surged again, flooding the system with new debt. Geopolitical tensions intensified, fragmenting global trade and weakening trust in the dollar system. Inflation proved stubborn, refusing to fall back to target levels without economic damage. In commercial real estate, a $7 trillion market entered a refinancing cliff as loans came due on properties worth far less than before. Each of these alone is manageable. Together, they form a pressure cooker. Goldman Sachs responded by reducing risk across the board. Less exposure to real estate, less leverage, more cash, more flexibility. These are not the moves of an institution expecting stability. These are the moves of a firm preparing for disruption. Of course, there's another argument, and it deserves to be heard. Supporters of the system will say bond selling is normal. They'll say yields are historically reasonable. They'll point to economic growth, low unemployment, and the dollar's reserve currency status. They'll remind you that predictions of collapse have been wrong before, and they're right about one thing: systems can persist longer than expected. But what history shows, without exception, is that systems don't fail gradually. They fail suddenly. Confidence doesn't erode smoothly, it snaps. Silicon Valley Bank was stable until it wasn't. Lehman Brothers was fine until it wasn't. The same is true for currencies and debt markets. Each crisis leaves behind more debt, more leverage, and fewer tools to respond. The margin for error shrinks every time. That's why understanding this matters. Not to panic, but to prepare. Practical steps exist. Reducing exposure to long-term bonds lowers vulnerability to rate shocks. Maintaining liquid cash reserves preserves optionality. Hard assets with intrinsic value provide insulation from currency risk. Reducing debt improves resilience. Diversifying income increases flexibility. Staying informed allows deliberate action instead of emotional reaction. The objective isn't to profit from collapse. It's to preserve stability through it. Crises don't destroy wealth randomly. They transfer it from those who ignore warnings to those who prepare early. Goldman Sachs didn't sell hundreds of billions in treasury bonds on a hunch. They acted because their data, models, and experience point to a system under strain with limited exits. The filings are public. The numbers are real. This isn't speculation, it's observation. You can dismiss it. You can trust that everything will resolve smoothly. Or you can watch what the most sophisticated institutions in the world are doing and ask yourself why. History will eventually answer that question, but when it does, the opportunity to act will already be gone. The warning has been issued. The repositioning has begun. The only remaining decision is whether you respond while time still exists, or wait until the consequences make the choice for you.